Depreciation. Now this is one of the most important concepts that you will be covering in your income tax syllabus, not only from the perspective that there are quite a few variations here, but also that whatever you do, whether you get a full length question or you are attempting a smaller part of it, depreciation does figure in some form or some shape or the other. Okay. Now, first, let us understand what the concept of depreciation mean. I know you might have read it in your 11th and 12th, or even otherwise you might be aware, but let me just briefly touch it upon as to what the depreciation is. Let's say, for example, our good old Mr. A bought an asset. Let's call this as plant. Now, obviously, a plant is made of iron, and as you use it, the value of the plant goes down, right? So with the usage or with the passage of time, the quality of this asset goes down, right? This reduction in the value of an asset over a period of time due to usage or maybe due to wear and tear is known as depreciation. Obviously, the efficiency at which the asset operates when it comes vis-a-vis, let's say 3 years down the line, is obviously different, right? We're not asking about technological changes here. So let's say, for example, you got technology A in this plant, and 3 years down the line, there's a new technology B, which is very good, because of which you decide to move out the plant. That is not depreciation. Depreciation is the wear and tear arising out of usage. Okay? Although even that can also be allowed as a deduction. You can write off the value of the plant and machinery if it is not useful, or you sell it and book a loss on that. Okay? But what we are talking about depreciation is only the wear and tear. Right? So depreciation is the diminution. Diminution means reduction in the value of an asset due to normal wear and tear and obsolescence. Okay, as you keep on using it, as the time keeps on passing by, the reduction that happens in the value of an asset is known as depreciation. Normally there is no depreciation which is there on land, because the value of land do not go down, or land does not suffer any kind of a wear and tear. Okay, and for income tax purposes also, there is no depreciation which is provided on land, even though it's an asset, right? Now for income tax purposes, generally depreciation is allowed on the written down value method, but in some cases, let's say for example in case of power companies, there is an option to claim depreciation in the straight line method also. Okay, we'll see more about the written down value method, what is the meaning of written down value for income tax purposes, and all in the subsequent slides, right? Straight line method is given only to certain selective companies, right? And unless that be the case, which is also kind of an option, I mean, it's not mandatory for power companies to claim depreciation on SLM basis or straight line method basis. This is most commonly written as SLM, and this is most commonly written as WDV, right? So we'll learn more about it in the subsequent slides. For now, just understand what's the meaning of depreciation and that it is allowed under the 2 method in Income Tax Act.